Well, it's now time for our weekly strategy session, and in the hot seat today we've got Charles Booth, Fund Manager from Truffle Asset Management. Thanks so much for joining us this afternoon. Charles, despite the positive momentum that's kicked into global markets today, we had just yesterday some saying that, the risks of a global double-dip recession seem to be growing day by day. What's your view? Are we going to fall in a heap, or are we going to find some support?
Well, the answer really is we don't know. But if we look at the level of the market, it seems to be in a broad range of fair value, probably at the lower end of that fair value range. And we say that for essentially two reasons. The first is if we look at price to books in the South African market over the last 30 years, they've averaged about just over 2 times, and we're currently sitting at about 2.5 times. If you look at global markets, the long-term price to book has also been about just over 2 times, but they're at 1.8. So there's quite a difference in the value of our market compared with global markets if we look at price to book. The second thing to look at is if we look at earnings yields, they're currently around about 7%, admittedly up from a low of about 6% a few months ago, but 7% is still a little bit lower than the long-term average. So I think those two point to the fact that our market is not cheap. But it's not grossly overvalued either.
How is this affecting your asset allocation at this stage?
Well, what it says to us is that the probability of a good outcome for the market probably equals the probability of a poor outcome. So we think that there's not enough margin of safety to be too aggressive, and therefore what we've done is we've been fairly defensive in positioning the portfolios. And what I mean by that is that the first thing we do is where we have flexibility, we're currently still holding a relatively high amount of cash, so that if the market does fall, then we will at least have some cash to buy in equities at cheaper prices. And the second thing we're doing is that we're putting a lot of effort into buying defensive companies. And what I mean by defensive companies is those companies that we are fairly confident that they can sustain their earnings, so they are not cyclical.
Of course, it's that entire debate that's been raging, defensive counters, do we stick with them as opposed to heading into the cyclicals, and some questioning just how much longer the run with the defensive space can actually go on for, seeing that they have already run so hard.
Well, I don't think it's a time issue. I think it's a valuation issue. So we might get to a point where cyclicals become very, very cheap, and then it's worth going for them. And to be honest, in some of them we're getting pretty close. Stocks that come to mind, like for example Anglo American, it's had a very bad run recently, but it's getting to a point where it is also coming into a value space. And we may well consider that into the future, but not just yet. Okay,
so let's look at where you are looking at this stage. And as you say, it's in the defensive space, and some of the stocks that are on your radar. Interestingly enough, we've got a Steinhoff, and it's a bottom performer today, only one of the top 40 to be trading in negative territory. But you say that there is some value that you're seeing here, so run us through the rationale.
Okay. The attraction in Steinhoff is the fact that they are becoming dominant in the furniture supply chain in Europe. They've just recently made the Conforama acquisition, as you're aware of, and there will be a lot of opportunity to take costs out of that supply chain. So we are quite confident that in the medium term, Steinhoff are going to show some quite solid earnings growth. Now, it might make great television, but you shouldn't be too hung up on one day's trade.
Absolutely.
In fact, Steinhoff did quite well in the second half of last year. And it is true that it has been pretty flat to down this 6 months, but we just think that the fundamentals for that company are still quite strong.
Of course, we were chatting to Ntombenhle Radebe at Nedbank a little earlier on, and she was saying traders, it seems at this stage, still struggling to make heads or tails of this deal with Conforama and what it spells. Also, we've seen this restructuring with JD Group, and that limiting its direct exposure to an African market. Does that at any point, present some headwind?
Well, I guess there has been the criticism that Steinhoff has been not exactly a transparent company, but we think that that's the opportunity, that if you do understand it and you do see the opportunities for the company in Europe, then one can take advantage of that in terms of what we think is a price that's not quite fair.
How are you seeing that opportunity in Europe at a stage where there's just so much uncertainty regarding economic growth, specifically in those peripheral regions?
Well, I think that's probably why Steinhoff is weak, because the short-term outlook for Europe is so uncertain. I guess in the medium term, one has to assume that people will continue to buy furniture, they will continue to improve their houses, etc. So the outlook for those type of goods in Europe must be reasonable.
Of course, this is one counter that stands to benefit from any weakness in the rand that emerges as well. Also, a player that's hinging on, what happens with currency movement is SAB Miller. It's exposed to currency risk, but it's also a player that you've had an eye on.
Correct. There's two challenges for SAB, which of course is also two opportunities. The first challenge is that the acquisitions that they have made globally, that is in Eastern Europe, North America and South America, generally the return on capital of those businesses have been lower than in the South African businesses. Now, you wouldn't expect them to ever achieve what they can achieve here in South Africa because they've got a virtual monopoly here. But they can certainly improve their return on capital in some of those other geographies, and of course that will filter through into very solid earnings growth. So that is their first challenge and opportunity. The second one is that they are a very big player in China in terms of volume of beer produced. But unfortunately, that is not translated into bottom line profits. So their second challenge is to turn their significant presence in China in terms of volume into a significant presence in terms of profit.
Yeah.
And if they can achieve those two objectives, the medium-term outlook for SAB's earnings growth is very good.
While it tries to achieve those objectives, we've got it pursuing still with acquisition opportunities. We saw just this week that failed bid for Foster's at this stage coming through. How are you reading that? Has that changed or triggered a shift on your view on SAB at any point?
Well, I have to say that we would be cautious about that acquisition because there is always a fear that they may overpay. The reality is that when they made the Miller acquisition in the US, I think that with the benefit of hindsight, we can say that maybe they overpaid a bit. So I wouldn't regard the current corporate action with Foster's in a positive light until we've finally seen a price. But I would caution that there is a risk that they may overpay.
Okay, so of course that is the concern that the market's been holding for the bulk of this week ever since that bid failed through. But it's not just the big caps that you've had on your radar screen. A small cap that has caught some of your attention as well is a super group, and this seems to be on somewhat of a recovery path ever since the company came within a whisker, I think, of bankruptcy.
Correct. Well, that's exactly the point. The company was nearly bankrupt. They've had a massive recapitalization. So the company is financially a lot stronger than it was a few years ago. There's a new management team in there. And you know, sometimes markets are not very forgiving and they take a bit of time to recognize the changed fundamentals. So I think that this is a slow recovery story. If they can get their returns up higher than they are currently, the outlook for earnings is pretty good. We personally rate the management highly, and we think that they can turn the business around. So we think that in the medium term there's a bit of upside.
But to bear in mind is that we are coming off a very low base here.
We're coming off an extremely low base and a base that nearly went bust.
Okay, so that's your strategy when it comes to defense of some of the stocks you're watching. You did hint, though, that there is some value starting to emerge within the resources space. And I was speaking to a trader this week saying that he wouldn't necessarily be defensive at this point at a time where there are these opportunities cropping up. You mentioned the likes of an Anglo-American, BHP. What's your view on your single stock commodities as opposed to those diversified?
Well, the problem with single stock companies, and you know, let's talk about gold shares or Kumba, is that you're so reliant on the commodity price. I mean, if you take, for example, Kumba, the iron ore price is currently about $180 a ton. Now, we don't know where that price is going to go. It's way above where it was a few years ago. So it's conceivable that that price could fall down to, you know, 120, even $100 a ton, in which case Kumba's earnings are going to come under extreme pressure. Now that is a single commodity risk, which I think at the moment is perhaps a little bit too much to take. The benefit of going for diversified miners is that whereas one commodity price might be going down, another one might be going up. So there's less volatility of earnings in the diversifieds.
And of course the double security that comes with that is we've got diversifieds already having discounted commodity prices much lower compared to where they stand at this stage.
Well, so is Kumba, to be honest, but I mean that is correct.
Okay, well let's take a look at how you're reading this story that's, where we are seeing the impetus for resources come back to the fore. It's driven primarily by China. So how are you reading that Chinese economic story?
Well, I guess it's difficult to be precise about China because you can argue for and against. There's no question that the outlook for China in the long run is very positive. It is extremely positive in terms of raising living standards of millions and millions of people, and that is going to fuel economic growth and therefore commodity sort of demand for a long time. However, you can also argue the negative in that there are some very worrying signs in China, particularly the property bubble. So that it's quite conceivable that in a short term, say in a year or 18 months, that China could have a big stumble. And if it has a stumble, then it will obviously reflect onto commodity prices, which will then affect some of the resource stocks. Now, in saying that, it doesn't mean it has to have a stumble, but it clearly is a risk.
Of course, we'll be watching developments there. Certainly, at this stage of the game, we've got markets, it seems, looking at the glass half full as opposed to empty. We've got Naspers and Richemont, two of the South African companies that have big exposure to that space, and top of the top 40 today. Charles, thanks so much for your time. Of course, Charles Booth is fund manager from Truffle Asset Management, talking about some strategic thinking.